45 years, zero name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Hi friends, Patrick Prunty here with Marshall Reddick. Thank you so much for joining me. This session, which is all about private credit, offers a ton of value. So I commend you for taking the time to invest in yourself and exploring what Marshall Reddick can offer in this space. As we dive in, I think it's really important to understand what is private credit. Simply put, private credit is non-bank financial institution money, loans, such that would be provided by private equity firms. These loans would be provided to companies, not to individuals. This is a rapidly growing, non-traditional space that offers higher yields compared to traditional loans historically provided by banks. Specifically for us, we are in the private credit space, the secured private credit space. That's what's really important to understand. And this is no different than the private credit space, other than it includes collateral to secure the loan. Secured private credit is prevalent in real estate where investors need quick access to capital and is the strict focus of our internal Marshall Reddick program. This is nothing new. We've been doing this for a very long time, and secured private credit is just one of those new buzzwords to describe what we've been doing for decades. Call it private money, call it hard money, trust deeds, mortgages, notes. These are all industry buzzwords to describe what we do here at Marshall Reddick and how we can help you from an investment standpoint. So as we dive in a little further, just to review some of our topics of discussion, we're going to go over a number of different things. And it's really my goal to introduce you to our private credit program and to help you understand what we can offer and why you should consider investing in private credit. As I'm telling you, it should be, and you need to have it as a part of your investment portfolio. So I think out of the gates, it's important to understand what does our program seek to accomplish and why. So we offer a market-needed financing solution. This is to the entrepreneurial real estate investor borrower outside of the traditional banking system. And we use a common sense approach that really avoids unnecessary red tape. It's that unnecessary red tape that slows down the lending process. And it's due to a lot of guidelines that are out there, a lot of red tape, a lot of bureaucracy that oftentimes isn't necessary. Our program also seeks to provide, on the other hand, a safe, a secure, a cash flow centric, high yield investment to the real estate investor lender. That's you, as a reasonably liquid alternative to traditional fixed income assets, CDs, money market, bonds, things of that nature. So the program really is twofold. It serves the borrower, it serves the lender or the investor. And we do so in a controlled environment. We at Marshall Reddick interview, underwrite, negotiate, approve, and arrange each and every transaction. And we do so between and amongst the parties, specifically the borrower and the lender, but also including escrow, title, the insurance carrier insuring the home, and the servicer servicing your loan post-origination. And we do all of this in an effort to earn fees. We're in business to make money, and those fees paid by the borrower, as is industry standard. We give you, the investor, two options, and we're going to dive deeper into this, but specifically option one, direct lending, option two, Marshall Reddick Mortgage Fund. And in either case, we continue to participate as a customer service agent post-origination. This is key. The participation varies, however, depending on the option that you choose. And of course, there are pros and cons to both options. Looking back on 2025, it was a banner year for us. And this isn't a surprise. In this space too, I'd like to beat down some of the industry news that's out there. A lot of people are concerned about the amount of private credit that's out there. But remember, our program is a little bit different. It's secured private credit, and we only make loans with real estate as collateral. Whereas a lot of the buzz and the news that's in the market today and about potential problems in the private credit market have to do with unsecured loans, specifically often to software companies. So we're immune to that. And we do one thing, we do it really well. And again, that's secured private credit with residential real estate backing that loan as collateral. Getting back to 2025, the year in review, again, a banner year as expected. I've got some information on the screen for you now to kind of understand a little bit about 2025. And then I'll look at our pipeline today. And I will also look at our historical outlook of our program, because it's not a new program. So over 120 million in total origination volume in 2025. And as I mentioned, you have two options to invest. To quantify, understand that the mortgage fund has more capital as a part of the origination. Okay, but the direct lenders still represent a good sized portion of our overall program. And this isn't our first rodeo, folks. We're originating more than $10 million in loan volume each and every month. Total loan count, also important to look at, more than 550 loans originated in 2025, again, giving you the breakdown. So understand, while the capital, the volume is greater in the fund, the count, at least as of 2025, is greater on the direct lending side. Both of these options are great options. And again, there's pros and cons to both. But as I mentioned, we're doing this with regularity on an ongoing monthly basis, clearly shown where we're averaging 46 loan originations per month. And an important thing to understand here is that everyone has the ability to get involved. We're not just a California lender. And in fact, most of our loans are outside of the state of California. We love California, of course, where our home office is here for Marshall Reddick, but there's a lot of opportunity and a lot of value in other markets. And I think one of the competitive advantages that we have is our low average loan amount. As you can see, a little over 200,000. And this is very representative of the loans that you'll find on our marketplace each and every single day. This makes the investment attainable. It makes it easily a part of your investment portfolio. This isn't just for the super wealthy. This isn't just for the family offices or the hedge funds. This is available for regular folks like you and me. And it can all be done through the Marshall Reddick Secured Private Lending Program. So 2025 was a banner year, but it wasn't just a one-off, right? And in fact, we expect 2026 to be even better and the future years to improve as well. There's a lot of reasons for that, but one of my favorite is our improvements in technology, but also our improvements in the growth in our team. But keep in mind that this program doesn't work without the capital. So here we are, and we're looking to lobby to those investors that are out there who may be familiar with secured private credit, or maybe they're not, but they're interested. And again, taking the time to invest in themselves and learn what we can offer you in this space. Going back to our current portfolio, now that we understand how things looked in 2025, right now, outstanding, right? We're at nearly 150 million under management. That's a great number. It's a sustainable number for the size of our team. And again, I like to give the breakdown between direct lending and the mortgage fund. That 150 million is spread out across 673 loans, and we're marching up to that 700 number. We should surpass that soon. We have lots of repeat borrowers in our program, and I think this is another one of our strategic advantages. We're not just lending to the weekend warrior, right? We're seeking to lend to professionals, folks that are in this space, that are geographically located near their property, right? A lot of times this is local real estate brokerages or property management companies, but we'll explore that further when we get into the types of people who borrow from us. To kind of quantify back on the top geographies, as I reflected on our current portfolio, important to understand, as I mentioned, that we have a vast footprint. Our top states in 5 order: Indiana, Ohio, California, Texas, and Florida. And I think a lot of folks might be surprised to see that Indiana and Ohio, staples in the Midwest, are leading the way in Marshall Reddick's program. Historically, however, let's take a look back. So this program launched in 2010. And we have been tinkering and putting together a controlled environment for folks like yourself each and every day. We brought on the mortgage fund 10 years later after tinkering and spending enough time to become professionals in this space. So as we approach 1 billion, and crazy to say that, but we're about 3/4 of the way now with over 700 million in loans funded historically. And again, just kind of giving the breakdown between direct lending and the mortgage fund, which are your 2 options to invest in secured private credit with Marshall Reddick. As I mentioned, this isn't our first rodeo. We've done this many times, and we're approaching 4,500 loans. Total loan origination in this program, all done internally, in-house, here in our Newport Beach, California office. As we move on, I think it's important to understand too, what types of loans do we originate? What would you expect to see out of our program? Understand this, we are hyper-focused on short-term loans, and we only do first lien. Trust me, if you're gonna get involved in secured private credit, you need to stay in the first lien position. Don't chase yield, don't get greedy. We also need to have good loan to value, secured by residential real estate only, and in our case, non-owner occupied loans, experienced professional borrowers, and they have to have skin in the game. That means down payment. These are some of the ways that we hedge our bet and manage our risk in this program. Specifically, now that we understand we are hyper-focused on the short-term loans, let's quantify that. The majority of our loans are going out in the 6 to 12-month loan term. And I won't dive into all the different ones, but understand that renovate, that to me means improvements, value add to the property. There's a lot of fix and flip here. It doesn't necessarily always have to be a flip or a resale, because we do have a lot of these entrepreneurial borrowers coming in, improving the property, and then looking to refinance and hold it as their exit strategy. We also support home builders, right, with ground up new construction. That would be build or construct. These oftentimes are a little bit longer in the loan term, but still in the grand scheme of things, very short, which provides us that much needed liquidity. We also do bridge loans, and this is a rapidly growing aspect of our business. Bridge to us means no improvements to the property. The improvements might be needed to the property. However, our borrower and their strategy is not to do the improvements. They may be buying the property at such a significant discount with the intent to just offload to someone who's going to do the heavy lifting, that's going to do the improvements before the property is returned back to the market for perhaps a first-time home buyer or someone upgrading to a new, nicely renovated home. Now that we understand the types of loans that we make, let's explore a little bit about the borrowers and who borrows from us and why. So right out of the gates, think about those we buy houses for cash type folks. I live here in Orange County, California, and for those of you close to me, you see those billboards as you drive up and down the 405 with the seller's advantage guys, really prominent we buy houses for cash type folks in our neighborhood. That's the type of investor borrower that's borrowing and leveraging secured private credit. They may claim that they're buying houses with cash, and some they may, but to scale their business, it's very capital intensive, and they're looking to professional firms like Marshall Reddick to provide that capital and to do so in an expeditious manner. So again, these borrowers are entrepreneurial investors. They don't just have to be the real estate, we buy houses for cash type folks. Oftentimes, they're small real estate brokerages or property management firms who have eyes on a lot of property and really understand the nuances of their neighborhoods. There are a lot of house flippers, however, but there's also, as I mentioned, the home builders, small developers. Marshall Reddick's exploring all of that space, as long as, again, it's residential and we can take that first lien position. We also fill a couple of other niche spaces, such as non-recourse loans for self-directed retirement accounts. Marshall Reddick has a wide footprint, and we seek to support those entrepreneurial real estate investors and their look to grow their portfolios in whatever capacity it may be. So why borrow private money? Why not just borrow from the bank or a traditional source? It's a great question. And the number one answer to that is speed. We're pushing out approvals and pre-approval letters in days, not weeks. My experience with banks and traditional financing institutions is that while I may get the best interest rate, the longest term, it's a really painful process and it's by no means fast. So if you need speed, as most of our borrowers do, you need to get into the private money space. Flexibility is important. Underwriting is important, okay? We can accommodate unique situations. We use common sense. And there's a million different scenarios that present themselves where the traditional or the bank lender just can't fill the void. They can't fill the niche. They can't get the loan done in time, and they can't help that entrepreneurial borrower make it happen. Let's talk about risks and loan default. Because let's face it, folks, if we're going to invest in secured private credit, this is part of the business. But it's really not that bad. And it's quantifiable. It's understandable. It's predictable. So in terms of our program and looking at this from a historical standpoint, we have 73 total loans who have completed in an event of default. 66 of those are with direct lender funded loans, 7 of those on the fund side. So I have some of those percentages. So understand that while it's a part of the business, it's seldom and doesn't happen very often. You just have to factor that into your risk analysis and appetite and what you want your portfolio to look like. Also keep in mind, just because you have a loan that starts in default, and even if it ends in default, it doesn't necessarily mean a loss of principal. Sometimes that happens, but oftentimes that's your choice. Remember, as the first lien holder, you have the opportunity ultimately in the event of a default of taking the collateral property if it doesn't sell for an amount sufficient to pay off your loan. Okay? As we further explore some of those risks, because it's really important to understand what those are and to be fully educated about the risk that you're taking, some of the main ones that I find after doing this for a decade or two, illiquidity, right? One of the best parts about secured private credit is the liquidity that it offers. But in the event of default, you can find yourselves in an illiquid situation where you're not able to get your cash, your loan money back. That would translate into a disappearance of cash flow. There also is a big opportunity or a possible opportunity for a lapse in insurance. The borrower is required to maintain insurance, but for some reasons, that insurance may lapse. Construction delays, cost overruns on those improvement loans, that's very possible. Decline in collateral property value, that's certainly a risk that you should undertake. Borrower default, in which case you may have to advance money to protect your security interest in that loan. Insurance is a good example of that. Borrower fails to insure their property. It's your prerogative then as the lender to step in and have what's called a forced place or lender placed insurance policy. Another example would be property taxes. You may need to advance property taxes in a default type situation. Ultimately, however, the worst case scenario, which again happens extremely seldomly, is that you as the lender could end up owning the collateral real estate. And from my perspective, that isn't that bad. I look at it almost in the event of those default situations as the possibility of owning real estate being purchased at a discount. I certainly don't want that to happen. right? And I approach every loan that I make or that's offered through our program through the lens of being okay owning it in the event I have to. If I'm not, I can't make that loan. Other risk factors to consider here, loan to value. And just very simple, and from an educational standpoint, the lower the loan to value, the lower the risk. The higher the loan to value, the higher the risk. Some other things to think about when evaluating whether to make a loan or not. What's the borrower's liquidity look like? Take a look at their bank statements. Understand what their capacity looks like. How many transactions are they working currently? These are all things that we internally do for you as the investor as a part of our overall secured private credit program and our standard underwriting procedures. As I mentioned before, we have a lot of repeat borrowers, and we seek to support those repeat borrowers and their entrepreneurial businesses. Again, think about the home builder. Think about the we buy houses for cash type company. We want those folks to come back and borrow from us on an ongoing, regular basis. There's a relationship there. We prefer it that way as opposed to lending to the weekend warrior or to someone we don't know. However, that does happen. And in those cases, we're a little bit more conservative on the underwriting, asking for a little bit more down payment, potentially charging a little bit higher interest rate. All of those things are risk mitigation tactics standard as a part of our program. Those are just some of the risks and the risk factors to continue, but keep in mind, Marshall Reddick, as a professional in this space, understands those risks, and we take a lot of that into consideration when loans are made available for you in terms of investment. I think the takeaway from what I'm trying to describe here, and certainly something I've learned over time, is that secured private credit is a predictable, safe, and low risk investment. It's extremely suitable for those who are seeking yield and cash flow. That's exactly what it is, cash flow. It's not like owning real estate. You don't have to manage tenants. It's not appreciation or tax write-off centric. It's pure cash flow. It's pure yield. It's pure income. And you need some element of that type of investment in your portfolio. Let's get back to the options that we offer to invest in our program now that you have a better idea about exactly what our program is. As I mentioned, first and foremost, direct lending. We've been doing this since 2010, and we continue to offer this for those who are looking for a more active, an individual approach, an option where you pick, you fund, you manage. Less diversification, of course, depending on the amount of capital you'd like to invest in this program. You can certainly build your own portfolio, but you may only have the capital to do 1 or 2 loans. There is more risk due to the less diversification and potentially a higher return for you. I look at direct lending as the active guy in the stock market. Options, puts, calls, that type of thing, day trading. It's very active. Okay. But again, there's a potential for a higher return. And if that's what you're after and you have the time, direct lending might be the right option for you. On the other hand, we've got Marshall Reddick Mortgage Fund. This is the passive group aggregated approach where we pick, we fund, we manage, tons of diversification. Our mortgage fund today, approaching 300 loans in the portfolio, offers a much lower risk, but a potentially lower return for you. Going back to the analysis of the stock market, instead of the day trader, the active investor rebalancing and managing his own portfolio, this is where you have a financial advisor, or you're investing in Vanguard mutual funds or Fidelity mutual funds. You have a manager that's involved that's doing the active heavy lifting every single day. And there's pros and cons to both, and we support both equally. As I mentioned, going back to the direct lending side and to try to understand some of the pros and cons here, there's definitely effort involved. And one of the biggest points to make there is the battle to stay invested. We make short-term loans. Those loans often pay off in 6 or 8 or 10 months' time. You get your capital back. When you get it back, you got to get it back invested. It doesn't do any good on the sidelines. So you're constantly needing to rebalance your portfolio regularly in an effort to avoid cash drag. It's great to earn 10 or 12% on an individual loan, but if you get that money back and you sit on it for 1 or 2 or 3 months, that annualized yield is certainly not equal to the note rate at that 10 or 12%. On the fund side, little or no effort involved for you here. We are battling to stay invested. And my goal as the fund manager is to keep $0 in cash in our accounts every single day. I want that cash out and working in loans paying 10 or 12%. I get my liquidity from the nature of our short-term lending, where now I have loans paying off every single day. This means that we internally as fund management are doing the rebalancing regularly, daily. We're doing so to avoid cash drag and to drive return on investment for your benefit. As for the expected return on investment, another really important question that I get asked regularly and I'd like to share with you. Starting again on the direct lending side, bit wider range here, 8 to 12%. And the range is wide because you have to take into consideration that cash drag. These are paid monthly. When you fund these residential real estate loans on a monthly basis, there's a monthly coupon that you have to collect, a monthly mortgage payment. Okay. And your return is heavily dependent on you, your speed, your choices, whether they're good or bad, and your risk appetite. Again, there won't be a lot of opportunities to make bad choices because Marshall Reddick's doing all of the underwriting on the front end and only producing opportunities that fit our guidelines, that are safe, that are solid, that are quality loans. But it is nonetheless dependent on your risk appetite. Whereas the 12 or 13% yield loans, those are generally going to be the higher loan to value loans and therefore the higher risk loans. So understand, if you're going to chase return, you're also going to be chasing a little bit more risk. As for the mortgage fund, a much, much tighter range of return on investment, 8 to 9%. This is paid quarterly. We, funding all of these loans, the same loans that the direct lenders are, we're collecting the payments monthly, but we're only aggregating, looking at the profit and loss statement and distributing 100% of the net profit on a quarterly basis. This is perfect for self-directed retirement accounts. And this has no dependence on you. And instead, it relies on our fund model, our guidelines, our underwriting, and fund management to make all of those decisions as you would expect from a professional money manager, an asset manager. Talking a little bit now about the factors which can affect return on investment. Again, it's risk appetite. And I find a lot of folks in the direct lending, they like to chase the higher returns. I'm perfectly fine with that. Just understand, if you're chasing the double digits, you need to factor in 2% of the time, so says the data, to experience one of those defaults. And if one of those defaults happens to have a loss, or at least not a gain on all of the interest that you're owed, right, that could bring your yield down from an overall perspective. Staying regularly invested. You got to avoid the cash drag. The goal needs to be earning safely each and every day. Borrower loan default, macroeconomic and political climates. Hey, we've got a lot going on in the world today, and a lot has transpired from the interest rate run up in 2022. We're still feeling the aftermath of that higher interest rate environment today. We're getting more comfortable with it every single day, but then we have all these political things that are happening. Costs are still really high. These are all things that can have an effect on your return on investment as it pertains to secured private credit. I think another issue there is the real estate market. Although I have to say, I'm really happy to be in the residential real estate space. It has proven extremely resilient year after year, market cycle after market cycle. So it is a good space to be investing, especially in a passive standpoint where you're not actually owning the real estate, you're lending secured by the real estate. Let's talk about roles now, because it's important to understand what's Marshall Reddick's role and what's your role as the investor. And so I would quantify that first by starting with what's our role? What's Marshall Reddick's role? And in that same breath, how do we make money? So it's our role, Marshall Reddick's role, to attract and build relationships with the borrowers. We need to produce the deal flow. We're charged with processing, underwriting, setting up the guidelines, valuing the collateral real estate, approving the loans, structuring the loans, and selecting the lender, whether that's the fund or one of our direct lending capital partners, who's going to be the lender, the bank, who's going to fund that loan. We're the broker. Our job, mostly pre-origination, is to arrange the transaction. That means that we're talking and working with escrow, title, the insurance carrier. We're working with the loan documentation and the funding, right? Wire transfer to and from escrow. We also stay on post-origination in one capacity or another, depending on which investment option you choose. That management includes servicer boarding, funds control, construction draw management, if you want to call it that, insurance monitoring. Remember, our goal to make sure that every collateral property is insured 100% of the time. Payments, extension, payoff approval, redeployment, getting you to get your money invested once again. That also includes, in those default scenarios, default management and loss mitigation. We have been through this. We know that you haven't. We can help navigate those spaces. But there is a limit, right? And when we need to bring in third-party counsel to help you, we will take a step aside and allow the servicer and counsel to move forward. Unless, of course, you would like to retain us and to have us on for project management, asset management, and those types of loss mitigation services. So let's then talk about the ways that Marshall Reddick makes money in our role. So if you're in the direct lending side, we earn the borrower paid loan fees. Very common industry standard. Anytime someone borrows money, they pay their loan officer, their broker, the person arranging the transaction, a loan fee. Okay, so these are loan origination, processing, and extension fees. We also earn a single fee, a flat fee paid by the lender. We call that our lender funding fee. That is the only fee that you as a lender, direct lender that is, will pay to participate in our secured private credit program. On the mortgage fund side, totally different, right? We are earning a management fee paid monthly. And this is based on our assets under management. And we also earn, and what we're really out for, is a share of the profits generated by the fund. And we can only participate in that profit share, given our operating documents, once our capital partners have received their preferred return. Now that we understand Marshall Reddick's role and how Marshall Reddick makes money, let's dive into your role and how you make money. Your role in this program is to provide the capital. And as I mentioned before, we are looking for more capital as we continue to safely and methodically build this secured private credit program. So you, as a direct lender or a fund partner, provide capital that makes the magic happen. Your role is to uphold your commitments. If you commit to funding a loan directly, if you commit to putting money into the fund, you're going to uphold those commitments and not renege on those commitments. You have to meet those funding timelines. And if you're going to be a direct lender and you're going to fund loans that have construction holdback, you need to meet your commitments in terms of regularly reviewing draw requests and regularly issuing out those construction draws that the borrower so desperately needs to keep their improvements, their renovations to the property going. You need to be an educated client. You need to spend time learning about secured private credit, understanding your status as an accredited investor, and using a lot of the resources that we provide. So the QR code that I have here will direct you to a really good article on Investopedia that defines accredited investor. This is not a new term. This is not a Marshall Reddick term. This is a government term and one that's important in our space. You also need to be a reasonable client. Don't poach. Don't try to cut out Marshall Reddick and go direct to our borrowers, right? We've had that happen. That's a big no-no, right? We're all here together. We're working together in this controlled environment that we've established, and we just need to have a relationship and make sure that we do that. We also need to understand that private credit and private lending, trust deeds, notes, mortgages, these are investments. There are risks, okay? So when we encounter one of those risks, right, and we encounter one of those defaults, especially if you're on the direct lending side, you need to work with us. You need to not be upset with us. Okay, we understand that it might not be comfortable, but the same kind of concept exists in your stock portfolio with your financial advisor. In the event of a volatile market and your stocks start to go down, do you call up and are you screaming and yelling at uh, um, your fund manager, your investment person that's helping with those? You're probably not doing that, right? That's just not commonplace. It's the same concept on this side. It's just most people are more used to the traditional assets, the stocks, bonds, and the mutual funds versus the alternative asset that we're talking about, secured private credit. Okay, so now that you understand what your role is as an investor in this program, what is your earnings? How do you make money? So on the direct lending side, right, we are offering you a lender credit. This is a cut of the processing fee paid by the borrower. We do that in an effort to offset your loan servicing fees that you'll have post origination. This also is a yield enhancement tool. But primarily what you're after as the investor on the direct lending side is the interest paid by the borrower. Again, at very favorable interest rates. Could be 9, could be 10, could be 11, could be 12%. That's really the range of interest rates that we offer. On the fund side, if you're an investor in the fund as opposed to in the direct lender, you earn similar but a little bit different. You're going to earn a share of the net income generated by the fund based on your percentage of ownership, and this will be paid quarterly. Your earnings will be comprised of two things: your preferred return first, which is the hurdle that we as the manager of the fund need to exceed and pay you, before there is a split of the profits thereafter. And we have 3 tiers for the profit split. These are all based on your capital account. Okay, could be a 50% split, a 60% split, or a 70% split, again, depending on your capital stack. So that is how your role and how you earn money in our private credit program. Now, as we sort of start to wind down this educational session, it's important to understand and to think about and to ask, why should I invest in your program? And from my perspective, there's a number of reasons why, but Marshall Reddick, as a professional in this space, having doing this for some time now, been through a number of different transactions. It's our education, it's our knowledge, it's our wisdom, it's our experience. We have seen everything. We know what to look for, and we can bring that value to you as the capital partner. There's integrity, there's ethics, there's professionalism. You're going to always get that from me and our staff here. Communication and customer service. I mean, as technology moves on, I'm sure you're experiencing it the same as I am. There are bots and there is AI answering all of our calls and directing us, and it's really hard to get somebody on the phone. That is something we take pride in ourselves is, if you need something, if you have an answer, if there's an issue, you can pick up the phone. You can contact your account rep or your investment analyst or the investor relations department in our fund, and you're going to get the answers that you need, right? You're going to have a relationship with the team here at Marshall Reddick. Some of our other advantages and why you should be investing in this program: vast network of industry contacts. Again, escrow, title, homeowners insurance, loan servicing, contractors, CPAs, all of these different parties, attorneys, if you happen to need them, right? These are folks where we have a relationship, and we're only operating in this secured private credit program in markets geographically where we have a footprint, where we have those industry contacts. Getting back to the staff, super hardworking, super dedicated. Someone like myself, I'll be celebrating my 24th anniversary working for Marshall Reddick. A lot of the folks on my team are reaching those milestone dates, 5 years, 10 years, and so on. Super proud about that, but it's all because we really like what we do, and we like working with each other and with you on a regular basis. I think rounding that out, and lastly, some of the themes of this session: secured private credit offers a superior mix of safety, liquidity, and yield. It's like nothing I've seen, and I've invested in just about everything real estate related and other that you can imagine. I've been afforded those opportunities through the career that I've had here at Marshall Reddick. And I have to tell you, a lot of my portfolio is invested in my own secured private credit program. And besides, regardless of whatever economic market we find ourselves in, secured private credit is predictable. It's fixed. It has less variables, and it has a place in your investment portfolio. Well, as we wind down, how do I get involved? Also really important to understand. A lot of new folks listening in, interested in what I'm talking about, but might need a little bit more information. So how do we do that? Okay, well, you want to get involved with us at Marshall Reddick in this program. We give you so many opportunities to do so, but investigate us, watch webinars, look at online reviews, ask for referrals. We'd be glad to introduce you to folks. Come to the office. Let's get coffee. All of those things are perfectly fine questions, and you need to do your due diligence. We're asking you to do that. You also want to consult with us, right? Decide direct lending or the fund, which is right for you. Again, there's pros and cons to both. You can use this QR code to schedule a consultation with us at any time. And as I mentioned, relationships are so vital. Build one with us. We certainly want to build one with you. We want to get to know you. We want to get to know your family. We want to get to know what you like, what you invest in, how we can best help you. We are always here to help. Okay, two last things I'd like to leave you with as a part of getting involved. We've created a marketplace on our website. This is like a multiple listing service for real estate agents, but it's for Marshall Reddick private loans only. You can find this marketplace right on our website. It's free to use, it's public, right? Learn to use it. This is where we publish all fully underwritten and approved loans. This is also where you, as the capital partner, generally the direct lender, shop for Marshall Reddick secured private investments. It's online, as I mentioned, it's public. It contains our entire operating history. The data that I shared with you in this session, all of that comes from this marketplace, okay? Both operates and works for direct lenders and the mortgage fund, because the mortgage fund is doing no different than the direct lenders, strictly investing in secured private credit with Marshall Reddick. This marketplace is live, it's fast moving, it's competitive, it's being updated 24/7, 365 by the team right here in Newport. I've shown a screen clip here of our website, and simply from the homepage, hovering over invest and clicking mortgages, that will get you to this mortgage marketplace that I've just described. What about the fund? Perhaps the fund is the route that you'd like to go, the more passive route. I encourage you to join. I've always got a quarterly fund investor call. Remember, our fund issues profits each and every quarter. We issue a quarterly memo, and I host an investor call. I encourage you to join. There's always one coming up soon. But in between that, you can always get more information about our fund on our website as well. At a high level, we're currently a Regulation D 506C private investment fund. Real estate investment trust edition coming soon. This fund is managed in either case internally by Marshall Reddick, and it operates in perpetuity. No end to the capital raise, no end to the operation. This fund just works forever. There's no load or investment fees, really important to understand that, and there's only a market standard asset management fee, which is an expense to the fund. So the returns, the 8 to 9% really tight window that I quoted for you, that is all net of the asset management fee. And remember, the fund strictly funding and investing in loans fully approved and underwritten internally by Marshall Reddick. Same but slightly different screen clip from our homepage. If you're interested in getting more information about the fund, we've set up a due diligence page that's ideal for brand new investors looking to get involved or current capital partners in that fund who are looking to stay on the up and up about what the earnings are, how much capital we have, and what our holdings are. So you can visit this to do that due diligence at your convenience. So I appreciate you being here. Always my pleasure to share the knowledge that I have and to introduce you to our secured private credit program here at Marshall Reddick. I look forward to the opportunity to work with you. And from our team to you, thank you for the opportunity to be of service. Got my contact information here on the screen. I'd love to speak to you directly as well. You're welcome to reach out to me. I'll be glad to meet with you, to discuss your goals, to understand how we can help, and then get you involved with those on our team who can get you onto the right trajectory in our program, again, with one of two options: direct lending, the more active, or Marshall Reddick Mortgage Fund, the more passive. Thanks again. Really appreciate your time. We'll talk with you soon. Bye now.